Good. Okay, thanks so much. And also, thanks for showing up this early. So this paper that I'm presenting today is still very much a work in progress, so any comments more than welcome. I need to apologize a speaker who was actually originally scheduled here, which is my co-author, Christina Tsura. So unfortunately, she is ill, so I'm stepping in on her behalf. And the rest of the team, this is Sylvia Castro and Tim Opitz, both from Munich. And the title is Gendered Access to Finance, Role of Team Formation, Idea Quality, and Implementation Constraints in Evaluations of Businesses or Business Evaluations. So all of this is going to come together in the course of my presentation. So very broad motivation. Finance is important for firms to be able to grow. Yet we still see that firms are not growing as we would have perhaps liked them to. And many of businesses, when you ask entrepreneurs what is constraining them, very frequently they would say financing. Now, since we're looking at the dimension of gender, let's have a look at how women are kind of experiencing financial markets. So on both kind of the domains of equity financing as well as debt financing, there is plenty of evidence, mostly coming from observational data, that women are facing tougher conditions on the labor market. So for equity financing, we are still lacking evidence from developing countries, also due to the fact that equity financing is kind of still relatively kind of less prevalent in the developing world. But still, also like from evidence from France, from the US, we see that women are having harder times attracting external equity. For debt financing, there's plenty of evidence also from the developing world where we see women are facing tougher conditions in terms of smaller loan amounts relative to their male counterparts, higher interest rates. They're more likely to be denied loans. And now this last paper, this Brocken de Haas. So this is one of the very few papers that are actually looking at like causal evidence, so using an experiment, and they're showing that women are asked to provide more guarantees for their loans. Okay. So what we are doing in this paper is we are focusing on the supply side of the market, and we're also digging a little bit into the mechanisms. So, okay, we are essentially relying on findings from two studies. One is going to be what we will call a main experiment. This is going to be an experiment with 451 loan officers from a major commercial bank in Uganda. And what we do is that we invite these loan officers into a quasi-lab. It's happening in their workplace, but we're doing some kind of an artificial situation for them in which they are, however, facing something that they are doing in their daily lives. They are evaluating businesses. And they are evaluating real businesses. So these are actually business ideas that were presented at a competition for startup enterprises for students at Ugandan universities from a different project of ours. So each loan officer is evaluating 5 business pitches. We will fix the order. And what we do is that we are exogenously manipulating the gender of entrepreneurs and essentially the team formation. So is it a kind of one-person business or is it a 2-person business? Okay. We rely on these existing businesses because these will serve as a benchmark for us. So we will be able to evaluate the responses of the loan officers and benchmark them to the actual performance of these businesses. Okay, so this allows us to actually incentivize their responses, and then we are also digging a little bit deeper into the mechanisms through which a bias. So now I'm revealing that there is going to be a gender bias, actually, in evaluations of these businesses. And we will be focusing at which stage, actually, this bias is manifesting itself. So is it already at the stage of the business idea? So is it that business ideas presented by women are evaluating differently from business ideas presented by men? Or is it rather at the stage of implementation, right? So is it the implementation constraints kind of that women are perhaps perceived to be less able to run a business? Or is it that these perceptions are that women are facing different types of external constraints? Okay. Next, we'll be able to say something about whether this bias is driven by animus against female businesses, and since we also have this manipulation on teams, individual versus two-person businesses, whether the bias is more prevalent for teams or for individual entrepreneurs. Now, as it will turn out, so I'm slowly revealing our results, that most of the bias seems to be concentrated at the implementation stage. We also employed a supplementary survey, which is going to be an online experiment with 180 loan officers from a different major but very similar bank. Many of the characteristics across these surveys are very much comparable of these loan officers. And we will be asking them about their perceptions of these implementation constraints and abilities that they have about exactly the same types of pitch decks that we have presented to the loan officers in the main experiment. Okay? For the contributions, there is a bunch of literature that I'll be happy to discuss with you afterwards. Let me just highlight two things in here. The first one is that there is still relatively little causal evidence of discrimination in access to finance. So there is now these two studies in here that I'm citing. And second, why would we expect that there is still some scope for bias in financial markets that should be efficient? Predicting success of businesses has proven to be very hard. So there is still lots of scope for, some subjective evaluations and bias to enter into the decision-making of loan officers. Okay? Design, main experiment. I talked about 451 loan officers already. There are two kind of dimensions of manipulation. First is the gender of the entrepreneur that we are signaling through names. We ran some survey. Everything works well on these names. So these are neutral names, but clearly identifiable as male or female. And formation of entrepreneurial teams. And here we're looking at these two stages. So first is the founder. So this is the person that came up with the idea, and then the implementer, which is the person actually running the company now. So this is what we will be manipulating as well. And in some cases, this would be a single person. In some cases, these would be two different people. Okay? And we are manipulating kind of the gender across. Now, on the outcomes that we care about, as I said, incentivized using actual business performance. There will also be some possibility of obtaining some costly information. This will allow us to say something about potential lack of information and whether there is demand for some extra information and whether this is perhaps gender specific. Again, this is going to be incentivized, and we will have some also some non-incentivized measures. All right. I think let me skip this. I'll be able to guide you through this conceptual framework kind of along the way. And let's start with this. All right. What we do first. Loan officers come to our lab. We tell them a little bit about what we are up to. They will be evaluating these business pitch decks, right? And then they start learning something first about the founder of this business. So this is the person that has an idea, right? And we are manipulating gender of that person. Then we show them the pitch deck, which is actually a PowerPoint presentation that these businesses or these entrepreneurs prepared. We remove any identifiers from that. Everything is agreed upon with the with the people who came up with these ideas. Okay, so they gave us approval to use these slides. So they have a sense actually about the performance of this company at the stage when it was presented. There is also some predictions, of the targets that the entrepreneurs are foreseeing for the future, etc., and well-described business ideas. Lastly, there could be either the same person or a different person as an implementer of that. Again, we are manipulating the gender of that person. And as I said, sometimes it is one person, both the founder and implementer, or it is two different people. Very short description of who the founder is. All the information is truthful, but we are manipulating the names. These are the red triangles, okay? So all of these are students from Ugandan universities, and they are young. That's it. Okay. Now, more details on the measures. First of all, investment. You can invest up to 5,000 Ugandan shillings if the business still survives, if it recorded positive profits. If not, you lose the amount that you have invested. Okay? You keep the rest that you did not invest. Best business, after you have seen all the 5 pitch decks, you are asked to pick the one that is performing the best. So here we are looking at the other part, at the right tail of the distribution of the success of the firms. Costless screening, this would be our secondary measure to tease out beliefs-based bias. At the end, we give people a chance to reconsider their investment for one payoff relevant pitch deck. Before that, we tell them, if you need some extra information, you will be able to purchase it. And each piece of information, we provide them with 7 possible pieces of information at 200 Ugandan shillings per information piece. So first, do you want information? If so, which information at a cost? And then some non-incentivized measures, idea quality, beliefs about profits. Okay. So hopefully this is clear. So I need to move on to our results. First result is going to be for individual teams. For individual entrepreneurs. So on individual entrepreneurs, these are founder and implementer in one person. We're looking at investment decision. And what we see that the investment decision, so the female dummy here is relative to a single or individual male entrepreneur, investment into their businesses is lower. It is more prevalent among people, among loan officers who exhibit a larger gender bias as measured using some questions from ISSB. If anything, a little bit more prevalent among women. We'll see that later. And with experience, it does not necessarily go away. These are less precisely estimated. We're running out of power, but anyways, I think it's interesting now. People are also more likely to predict that these businesses are more likely to fail. So female businesses, this is non-incentivized, but anyways, it's nicely correlated with what we would have expected. What about picking the best business? Again, we see a gap. The gap is now much larger. So essentially relative to an individual male entrepreneur, female businesses are 27% less likely to be selected as the best business. And again, more pronounced for high gender biased female and unexperienced loan officers. In here, our results are actually already significant. If I showed you the regression analysis in here, I'll show you very quickly. You can see the stars over there. Now, back. What about the teams? For teams, we don't see anything. No difference in investments. If anything, extremely small, no heterogeneity along the dimensions that I have shown you. If anything, there is a slight preference for female businesses in particular, female founder implementer, there is no statistically significant difference from the male. If anything, there is a little bit of a kind of distaste, if you wish, for kind of these non-homogeneous teams. So male, female, male. Okay. Bunch of robustness checks that I could have shown you. Reassuringly, our measures that we would have thought should be correlated are correlated in an intuitive way. So idea quality together with investment and selecting the business as best are positively correlated. Business failure negatively correlated with our incentivized measures. No ceiling or potentially floor effect, so we are somewhere in the middle of the distribution, and I have also shown you the distribution of investments, let's say. And few more robustness checks. It seems kind of very stable, this result. Now, why is that? So what we are trying to do, so conceptually, we are trying to think about taste versus beliefs-based sources of bias. So in the first one, we will be asking the question: is there some gender bias in the costless screening? So is there perhaps some information that is missing? And if we provide that, would it potentially reduce the bias? Second, what about the idea quality? So is idea quality perceived to be different by gender? First, let's have a look at the costless screening. Summary of the results is that there is no difference whatsoever by gender, neither by individuals nor by teams. So there is a positive demand for information, about 37% so this is a benchmark for male, individual male, but there is no difference across the board. So there is some demand for costly information, no gender differences in that. So it does not seem that there would be relative lack of information, okay, about female businesses. Second, on idea quality, take it with a little bit of a grain of salt. This is a non-incentivized measure. Still, we found it to be correlated with our incentivized measures. No difference in idea quality perceptions. So here, relative to, this is for individuals. I should have somewhere a link to the teams. Anyways, it's not, there is no difference in idea quality for teams either. Okay, since I have 2 minutes now, super quickly on the supplementary survey. Supplementary survey, 180 other loan officers from 8 different banks are seeing exactly the same pitch decks. Now we're not asking them about the investment into these businesses, but we're rather asking them, since we see that what is remaining is actually this implementation ability or constraints part, we are asking them about their perceptions along these dimensions. Okay, so for implementation constraints on a Likert scale, we are asking them about, family obligations, networking opportunity, personal safety, credit limitations, access to startup capital support from family and friends, implementation ability, entrepreneurial mindset, commitment to the business. Okay, so here, very quickly, the results will be focusing, for the sake of time, on the first line only. Female entrepreneur, this is individual and female entrepreneur relative to an individual male entrepreneur. These are the Likert scale readjusted. So let's not talk magnitudes, let's only talk the direction of the treatment effect. No family obligations seem to be perceived as kind of less prevalent for female, so they seem to be more family obligations constrained. Networking, lower access to networking. Safety, if anything, perceived to be higher for female entrepreneurs, somewhat surprisingly. Capital from friends and family, less access to it. Okay. Super quickly in the last 30 seconds, I think. what are the perceived determinants of a success of business? So again, we asked about the same businesses. How likely do you think this particular business succeeded? And we are now correlating that with our measures of perceptions. And what shows up is that business success seems to be positively correlated with having no family obligations for individual females, and positively correlated with safety on the workplace. Okay? On implementation ability, and this is something related to, let's say, the idea quality, these are both positively correlated with business success, but no gender difference in there, as we have seen on the previous slide. So the takeaway, family obligations seems to be the key kind of implementation constraint that is predictive of business success to individual female entrepreneurs relative to males. On implementation ability, we don't see anything. So main takeaway, there is a bias against individual female entrepreneurs, mainly driven by these constraints, especially through family obligations. Thanks so much.
Okay, thank you for the interesting presentation and also very interesting paper. So I like the creative setup, and what I also like is that you now added this supplementary survey, which was not yet in the paper, and I think allows you to dig a bit deeper into the mechanisms. So I have a few questions. So the first one, I think the result that the bias among female versus male loan officers is, so female loan officers have higher bias against women. I think that's an interesting finding. You mentioned power, and that was also one concern that I had. But I was wondering if you could dig a bit more into this difference by the gender of loan officers. So, for example, this demand for additional information, does that differ by gender of loan officer? No? Okay. But so I find that also, interesting to explore further. Secondly, this distaste for non-homogeneous teams, I think, is also a very interesting finding. And I was wondering if you have any information, maybe from the supplementary survey, that male-female teams are perceived as being spouses, and that like creates an idea that the implementation, or that women are more constrained if the business or the founder or the implementer is their husband. And then a last point is about generalizability. So I think it's a big strength of the paper that you're able to isolate the supply side discrimination, but also that you're able to do this in a real world setting. And you also did extensive testing to ensure the setup works with the names and so on. So I think that's really nice. Still, I was missing a little bit of information in the paper on how well these scenarios mimic the usual jobs of the loan officer. So are they the person that indeed make decisions on loan approval, or are they just the first point of contact? Do they do any screening in real life? How representative is this virtual deck? Is this the usual way that these loan officers work? I imagine it's more often in-person pitches. So maybe, that's just for a discussion. And then the fact that they invest with their own money versus provide loans, that might also be something to dig into a bit deeper to discuss. So yeah, those were my comments. Thanks again.
Yes, thanks a lot. Okay, so thanks. These are all great points. For the first point, female loan officers actually seeming to be harsher. We were also kind of puzzled by that. So the only kind of thing that we could relate this to, so we describe this in the paper as this so-called queen bee syndrome. So this is like when you have some like asymmetric power relations, let's say on the labor market, right? That like female managers are harsher, for example, in evaluations of female applicants. So there is some evidence on that. So we are thinking of this as being kind of relatively similar scenario where you have the loan officer who kind of has power over the decision about the loan approval for this. So this is the best that we can do, but we do not find kind of other, let's say in the screening. So there is nothing like that. We were expecting, for example, female to be, or some kind of like homophily, right? Nothing like that in the demand for information. So really, people seem to be holding kind of very strong beliefs about these entrepreneurs. This states for non-homogeneous, we don't want to spend too much time with that because like we feel that we are little bit underpowered. So this is really manifesting itself only on the dimension of picking the best business and not elsewhere. So we present it still for the sake of completeness of the results, but it's like the weaker of the results, we think. Generalizability, I could probably talk for a very long time. It is something that is a little bit unusual, right? First of all, kind of evaluating businesses based on their predicted performance. But this is ultimately what you need if you really want to launch kind of a startup scene. If you want to, let's say, have like a well-developed kind of venture capital scene. So we think that this is still the most relevant sample for these types of decisions. They are engaged in, loan approvals. But you're right that it goes a little bit beyond, but these would be exactly the people who should be doing these types of decisions. Thanks. Yeah, happy to take some questions.
We have about 3 minutes for questions from the audience. There is one. And then where it's coming.
Can I just quickly to add on to what Lise has said, do you have information on risk aversion, and can you show heterogeneity by risk preferences?
We don't. If anything, then it should be females kind of being more risk averse, kind of what we know from other studies on risk preferences. And then, we still see this bias kind of manifesting itself more. It could be. I see. Okay, no, that's a good point. Yeah, thanks. Hi
there. Thanks for your presentation. Hi. Really interesting. I want to ask you about the sectors that the pictures were made in, because we find a result in Ethiopia that the bias is happening in kind of male-dominated sectors. So I was wondering if you saw the same in your study.
I see.
Thanks.
Okay. So we took kind of rather neutral businesses. We also asked about perception. So do you perceive that this idea was actually developed by a male or a female? And we are asking about like their probabilistic beliefs. The businesses are all kind of slightly tweaked towards being perceived as more male, but not universally so. Okay, we're talking about agriculture, we are talking about some tech, we are talking about some restaurants, and we are talking about some trash business. So this is kind of like the dimensions that we are covering. So it's pretty much throughout. Thank you so much.
Okay, good morning, everyone. My name is Lise. I'm a PhD student at the RWI Leibniz Institute for Economic Research in Germany, and this is joint work with Christina Petrick and Jörg Ankel-Peters. So I'm going to present a project that is titled Lost in the Design Space, Construct Validity in the Microfinance Literature. So in this paper, we try to make a very straightforward point about construct validity, an important element of the generalizability discussion that is relatively unknown in economics. And we use the empirical microfinance or the experimental microfinance literature as an empirical example. So the motivation for this study is that randomized controlled trials are valued for their high internal validity, but their generalizability is potentially hampered. So often experiments do not replicate beyond the particular setting in which they are implemented, and this could be due to low external validity or construct validity. So while external validity refers to the sample and population-related features, construct validity is about the operationalization of the variables. So we have construct validity of the cause, which is the focus of this paper, and the construct validity of the outcome. So in the case of the RCT, construct validity of the cause refers to how a treatment that is implemented in an RCT relates to the broader construct that we make inference on. I want to talk briefly about an epistemic model that is prevailing, or that discusses how we generate knowledge from RCTs. So the current thinking, this pointeist painting, this epistemic model of the pointeist painting, assumes that we conduct experiments. Each experiment is like a dot on a painting. On its own, it may not mean much, but then when we accumulate these dots, we get this picture that helps us to make sense of the world and guide policy. So the implicit assumption here is that external validity and construct validity will ensue automatically if we carry out enough experiments. But the question is, how many of those dots do we really need? And what our messages with this paper is that construct validity increases the number of required dots. So what we do in this paper is we provide a conceptual framework to explain the importance of construct validity, and then we review the experimental microfinance literature to better understand how important construct validity is for generalization. So we have a sample of 47 randomized controlled trials, and from this sample we elicit design elements. So those are key features of a microfinance intervention that all together constitute this microfinance construct. So one example is repayment frequency. When we combine these 21 elements, we get to a very large number of unique microfinance interventions. We also demonstrate that some of these design elements are consequential for the observed impacts. And this together makes this pointeist painting hard to compile. And then in the second part of the empirical part, we go to the 47 papers and we assess how they deal with construct validity and whether they generalize beyond the operationalized treatment to a larger construct. So the framework for this, so on the left-hand side, you see the operationalization of a single RCT. Z is a random assignment, A is your treatment, B is your outcome, and C is your context. So we are able to identify the impact of A on B in C. However, the level at which we make inference is depicted on the right. So is a more conceptual level, and based on this RCT or on multiple RCTs, we make claims about the impact of alpha and beta and gamma. So in the case of microfinance, for example, we conduct an RCT with as treatment group loans with a monthly repayment scheme. We measure household income as an outcome variable, and the study takes place in Western Kenya. But on the level of inference, we draw conclusions about the impact of microfinance on welfare in sub-Saharan Africa. On the left, you see the depiction of this alpha, so this broader construct, and alpha is what we call the design space, or this universe of potential operationalizations. So A1 to AN are all potential microfinance treatments. Each one represents one single operationalization. Now I zoom in to one operationalization. This one, or each operationalization, consists of several design elements, D1 to DM. So these are all features of an intervention that may or may not matter for the impact that you find of this intervention. And each element takes a different value or dimension in each A, or in each operationalization. So from this, we extract, or we will look into two research questions. So first, how multidimensional is this design space in the microfinance literature? And secondly, do these variations actually matter? So will these different A's have an impact on the wider, on the outcome beta? Now I will zoom in to another operationalization, AJ, to show a hazard to construct validity. So in this case, AJ contains elements, DN, that are not part of the construct alpha, so not part of this microfinance construct. So for example, think about the case of researcher special care, which may occur in randomized controlled trials. So researcher special care occurs when researchers interfere with the treatment in a way that it will deviate from the real world construct alpha that we are interested in. Researcher special care may affect the program's effectiveness, so there is emerging evidence that shows that the way researchers RCTs are implemented may impact their findings. And so here we consider researcher special care as a separate design element because it's part of how the treatment is delivered, and therefore it also affects the construct to which we generalize. So the example here is that alpha is a real-world microfinance intervention, whereas AJ is a researcher-implemented microfinance treatment. So the drawing inference from this AJ to the wider construct alpha or here construct validity, or here researcher special care would be a hazard to construct validity. So from this, we come to two more research questions. So with the sample of the microfinance studies that we looked at, we will check whether papers discuss researcher special care. And then lastly, we will check whether papers generalize to a broader construct beyond the operationalized treatments. Why microfinance? So microfinance is just one empirical example that we use here. Microfinance is a flagship topic of the RCT movement, starting with the special issue of the AJ Applied in 2015, where 6 studies looked into microfinance, found similar findings, and in the editorial of this special issue, it was said that the collective spanning of different contexts, but also the similar findings, gives external validity to these studies. However, since then, many RCTs have followed. So the question so why do we look into microfinance? Where, if not here, should this pointillist painting take shape? We're not the first one to look into generalizability of the microfinance literature, so there's been some studies pushing back on microfinance and on the AJ Applied issue, raising concerns about the external validity of these studies. And there's also papers looking, using Bayesian hierarchical modeling to look into the external validity of the special issue. So we focus here systematically on the operationalization of the treatment, and we look at a larger sample of studies. We collected 47 papers from 3 sources. So we started from the Vojtech lit. I think it's a well-known literature review. We looked at the 2 issues on microfinance, and we extracted all papers from the Vojtech lit that fulfill our criteria. We also did backward snowballing on the 33 Vojtech lit papers, resulting in 7 more papers, and then we also did a systematic search to ensure that we do not capture a narrow part of the microfinance literature, and this led to 7 more papers, so 47 papers in total. All these papers are randomized controlled trials that look into a microfinance intervention on a welfare outcome. So we excluded papers that only look at take-up of a microfinance loan, or studies that look into take-up of assets but not beyond. The studies take place in low and middle income countries and are all published in econ journals or econ working paper series. And then 2 readers independently read each of the papers, extracted key information from each paper. So, on to my results. The first research question. So, we use these 47 papers to provide a sense of this design space of a microfinance treatment. So, we use design elements that are brought forward in the papers. And together, these elements form the design space of a microfinance intervention. So here we use two approaches. On the one hand, we extracted all the design features that were mentioned in the titles or the abstracts of the paper. So as soon as a paper talks about group loans, for example, we elicit group liability as one design element. And then secondly, part of the papers in our sample are studies that have multiple microfinance treatment arms. And so they compare different microfinance interventions against each other and randomly vary one design element. So these elements we also extracted, which results in a design space of 21 unique design elements that together constitute this microfinance construct. This is a conservative estimate of all potential design elements that relies on the two approaches that we followed. So here you see the 21 elements that we identified. So each dot, each purple dot is a design element that can be coded binary, or these branches could even branch out more. So for example, on the right, you see repayment frequency, monthly repayment frequency, or another repayment period, but this could branch out more. So this is to show that the potential number of microfinance interventions could easily become very large. Secondly, we check whether these variations in the microfinance treatment actually matter for the observed impacts. So here we look at the existing literature that compares different microfinance interventions in one RCT to show that some of these studies do find that small tweaks in the intervention matter. So I show here for profits, but we have more outcomes in the paper. So on the left-hand side, you see all studies that randomly vary one design element. So for example, the first study looks into whether or has a treatment arm with monthly repayments and a treatment arm with weekly repayments, and finds a positive impact on profits. So with this graph, we want to indicate that the existing literature shows that design variations may matter for the observed impacts. Now we go back to the 47 papers and check how they deal with this multidimensional design space and whether there is sensitivity for construct validity. So we first look into researcher special care, which I showed in the conceptual framework. We use researcher involvement in the implementation as a proxy for researcher special care here. And we check the 47 papers to see whether they deal with research or whether they discuss researcher special care explicitly. So 73% of the papers do not mention any involvement of the researchers at all. 7 papers do mention that the researchers were involved. 4 papers mention that researchers were not involved at all. So these 11 papers demonstrate that more clarity is feasible. Okay, so I have demonstrated now that microfinance is not this monolithic construct, but perhaps each RCT only speaks to the generalization of the very specific intervention it evaluates. So we also assess this for the 47 papers. We check whether they generalize beyond what they implement, and there we see that the majority of papers, so 74%, generalize to a wider construct without providing any justification or assumptions for their causal claim. And this is, as I show here, it's a combination of these 4 findings that matters, right? So we showed that the number of potential operationalizations is really large, that design elements can be consequential for the treatment effects, that there is not much sensitivity for the relevance of design features such as researcher special care, but papers do generalize to a wider construct. So the argumentation here relies on the combination of these 4 findings. And so we argue that the need to establish the different types of validity arises with the claims you make in the paper. So if you claim causality, there is a need to establish internal validity. If you claim generalizability to other settings, there is a need to establish external validity. And similarly, if you claim generalizability to a broader construct, so from your treatment to microfinance or another or an operationalization, there is a need to establish construct validity. So what we conclude from this is that more sensitivity is needed for how we design treatments and also how we generalize from those. So more sensitivity and more transparency in discussing the design elements of an intervention, and for construct validity, so what construct can we generalize to? And when aggregating evidence in meta-analysis, for example, there's this need to be aware of this heterogeneity, not only in context, but also in constructs. And then the open question is, of course, to what extent do these findings generalize to other interventions? We only looked at microfinance as one example. I believe that the practice or having a complex intervention is not unique to microfinance, nor is drawing generalized claims. But yeah, that's an open question for future research. Thank you. I think I went very fast.
Okay, no, thanks. Let me apologize. I don't have the slides. I think I've been here like many years back, and it was like asked not to bring slides. So, but in the future, I will have. So, I think it's a very nice. It's a thought-provoking paper. I like it a lot. I'm not like a person doing randomized control trials. I read them. I use the literature. So maybe my comments come a little bit from a different perspective. Let's say. I would like to raise a couple of points, 2-3 points, which are somehow also you have in the final conclusion. I think my general point is while I like the sort of the tone and the fact that, it's always good to bring a little bit more thought about like how we read and how we try to generalize from studies, I wonder if you're sort of setting the bar a little bit too high. And let me elaborate on that. So one thing that I haven't found in the paper is when I approach and when I read some of these studies and I think about how can I learn, which is beyond the study, I tend to think, first of all, based on theory. So can we use a theory to sort of discriminate and try to think about what is generalizable and what not? I think if we are guided through some very strong theoretical background, I think we can do sort of a little bit more of generalizability, which could be external validity, or in this case about context and construct. So I guess that's an element that if you bring in, because I guess the whole point is that I think in my reading of your paper, the whole big issue is that when you have all the potential dimension, you say you can keep on branching out. And I think there you're literally say, if I can go with all possible combination, I have sort of an infinite amount of dimension. I think you can restrict that in a number of ways. One is theory, and the other one is, I think this design space is broad, very broad, because some intervention clearly depends on what's happening on other potential dimension. Like if I go on your example, for instance, you can have the repayment frequency. And that clearly depends if that goes with another dimension, which could be urban versus rural. And then I understand that sort of the fact that you have to walk and repay every week or every month or every whatever. It depends if you are in a city or if you are somehow in a rural place. But some other dimension of this, of the same microfinance, which could be the commitment device, then it's hard for me to think that a commitment device can have such different effect if I evaluating two different studies in an urban context versus a rural context. And I think one can come up with different and a variety of examples in which some of this dimension in which the researchers is playing around, the intervention, are kind of orthogonal of a number of other setting, and clearly some which instead clearly depends on some of these other settings. So I guess there is a way to sort of bring this big gigantic thing in a smaller sort of setting, and not to say that what you're saying is irrelevant. I think it's very relevant, but it's maybe a little bit more confined than sort of the perception that one have reading the paper. So these are sort of the two ways. So I would try to think about okay, there are all this product space and some are relevant and some less, and the other one is theory can help me. And that said, then so once you take that into account, I think whatever you have here is very relevant, it's very sensible, and people should use that reading the results. And the other point that I have, reading the paper, is basically what you have at the end. So it's all about microfinance, and my question, again, coming from somebody who doesn't really know some of the things you have discussed in the paper, is okay, fine, but this is really like specific of microfinance. Is just the microfinance researcher particularly bad or good in that, and other people doing randomization are much better or much worse? I think that's a good question to answer. So, how that differentiate from other sort of approaches, even outside of economics, no? So, like, are economists a little bit lighter in sort of reading and interpreting their funding than other social scientists, or maybe we're better than other people? So that's a good. I think it's a question that it's worth asking. In terms of the study per se, I have a couple of sort of questions. Meaning, I kind of understand how you select these 47 papers. I think, given that at the end of the day, the conclusion you have here are basically a call for like rigor in reading and interpreting and generalizing the finding. I think you should apply somehow a little bit more rigor also on the way you present and the paper you have. So how you select these 47 papers, you have slides to describe them, but to me it seems some of the sort of choice of this paper a little bit ad hoc. Again, it's not that I'm super expert in the literature, but I think, I remember I've read more than 47 papers on randomization in microfinance. So why 47? And, I understand you start from the box dev literature, nothing against box dev, but, it's not necessarily the first thing that comes to mind if I have to start thinking about those papers. And then from then you pick some other 7 from snowballing, some other 7 from some other way. So I think a little bit more of systematic choices of those papers, it would be important. And final point is sort of more as a policymaker or user of these studies rather than an academic researcher. Again, in the way of why you're setting the bar a little bit too high, is like at the end of the day, you need to come up with some policy. You need to generalize. And I think, there is a trade-off here. And I think, maybe it would be nice and interesting to read those papers and try to understand which of those papers generalize too much. Maybe like, if there is a difference between maybe a version of the paper you could find published in AER or AJ Applied from the working paper version. Maybe like in the working paper version, you just start blah, 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 and then you cut. And in an academic paper, you or maybe it's the opposite way around. I don't know. Meaning, it would be nice to see like in which kind of context people try to sort of go too broad or stay narrow. And let's stop here. But again, it's super interesting, and I think it's an important reading. Thank you.
Okay. Yeah, thank you for these comments. I'll try to respond briefly. So on the first 2 points about like whether theory decreases the number of dots, but also interactions between the different design elements, I think that's a very fair point. And my response to this would be like, maybe we need more research into how this then decreases this design space and how we can learn from that, how we aggregate evidence. Because right now I think there's little guidance on how to do that. The question about the other literatures, that's a fair point, and maybe future research. Also, your comment on more rigor in the choice of papers is well taken. We started from the VoxDevLit because I think this depicts the current thinking on experimental studies in microfinance, but then also to address the comment that we may be studying a narrow literature. We also did the systematic literature review on top of that, which only resulted in 7 more papers. And then the question on policy recommendations. So I think the question also is like, are policymakers seeking these broad generalizations based on a single paper, or would it rather be helpful if we're more rigorous in describing exactly what intervention we implemented in a specific context, and would that maybe be more insightful? So, I think that's that would be my response to the last point. Thank you for these comments.
Thanks. Questions? 1, 2. Okay, let's get started.
Thanks. Super interesting. I was curious if you thought about looking at other methodologies, because this doesn't seem unique and in fact seems potentially more difficult if you're, say, estimating a macro model and you need to operationalize capital somehow, right? Like, what does capital mean? And I'd be interested to know kind of where do RCTs fit in the spectrum of this? I understand there's a lot of discussion about external validities of RCTs, but I'd just be curious about the others.
Yeah, thanks. So we chose RCTs here because of their prominent role in the credibility revolution and because of their high focus on internal validity, maybe at the expense sometimes of external validity and construct validity. But I absolutely agree that we could apply this also to other methods, quasi-experimental methods, other literatures. So we focus on RCT as an illustration, but I think the conceptual framework is transferable to many other methods and literatures. Yeah, thanks.
Well, so this reminded me of this paper by John List, the generalizability known as disputandum, right? So I was just wondering, because like what he essentially does is that he boils down generalizability into this SANS concept, right? Which is scaling, attrition, and S, naturalness, and what is the last one? I don't know. So I was just wondering kind of how to reconcile the two, right? Because like it seems like John's kind of approach would be very kind of rather lax. Yours is extremely kind of strict.
Yeah, I think so far in economics, construct validity, if it's being discussed, it's captured under generalizability. So I also don't know where it would fit into the framework, but I do believe it's valuable to think about this as a separate type of validity, apart from external and internal validity, and discuss it more explicitly. And I would need to dig more into the framework, but I at least construct validity, I don't think it's explicitly considered there.
All right. Anyone else?
Hi, thanks for the very thoughtful paper. I was just wondering, have you thought about weights about different parameters? Like you have 21 parameters you're weighing on, but there might be something which would be very important versus something is not very important, right? So how do you think about like weighing different parameters if you're thinking about a meta-analysis kind of framework for this?
You mean specifically these design elements in the microfinance, which elements might be more important or not? Yeah, we thought about looking into this in more detail, but we think it's a completely different point. So we don't know right now how we should compile from this evidence what elements may matter more. And I think we need more work on how to aggregate RCTs and how to learn from that to answer that question. I don't think we would be able to do that.
All right. One more question here.
Thanks for the presentation. One comment and one question. So the comment is that when we work with especially large-scale interventions implemented by government, the other element is implementation. And there's a lot of variation in implementation, and we know we kind of have to live with it. But just to flag that, that's another bullet point here in terms of claiming generalizability. The other point is maybe related a little bit to that question is, there are clear recommendations for individual papers, but what are the recommendations in terms of meta-analysis, which is the tool we would have to kind of address this question? And there we know we have to give, we have to start pulling different types of interventions that are somewhat related to generalize a bit broader.
Yeah. So I think one thing that we experienced doing this is that many of these design elements are not mentioned in many of the papers. So for example, not all papers mention what the gender of the borrowers is, that of the intervention that they study, for example. So I think this is a first step for individual papers to make meta-analysis on these or to account for construct validity in meta-analyses. And I think for meta-analysis, it's important to consider construct validity as an important explanation in the variation of effects that we may find. And I think that's relatively little discussed at the moment. So I think that would be one recommendation. So how to tweak meta-analysis or how to conduct meta-analysis taking construct validity into account.
All right. Thanks a lot. Now we move to
Thank you.
Okay. So Thank you very much. Thanks for having the paper in the program. This is joint work with Andrea at the Bank of Italy, Patrick at the National Bank of Rwanda, Roland was with me at the IMF, and Nicola Limodio at the Bocconi University. Usual disclaimers applies, and my own views, not the views of the IMF or the Bank of Italy. So that's the paper on mobile internet, the collateral and access to bank credit. And exactly because of what I said before, it's a paper using administrative data and no randomization. So let's go into the paper. So the idea of the paper in a nutshell is try to look at the sort of complementarities between technology and law and see how that can promote access to finance. We know from a very vast literature on mobile internet and internet technologies more generally that internet can have a lot of effect on our society, and one of these effects is through bolstering financial markets for a number of reasons. Clearly can improve and enhance individual knowledge, can facilitate access to property rights, and there is like third-party validation. All these elements are particularly valuable in a developing country context, for instance, because of weak institutions and tight financial constraints. So if we look at the situation in which there is a land reform, that's, in our view, is an ideal setting to understand the complementarities between technology, law, and finance. And the basic idea that we have and we want to test in the paper is that internet can actually facilitate the development of a collateral system. In this way can enable individuals to leverage their property right, and through that, through the sort of property, the sort of access to land and possibly collateral, then people can actually have access to finance. So we look at sort of the complementarities between the two, so the law part and the technology part can actually help people moving from access to standard microfinance products to sort of graduating and having access to bank finance. So in a nutshell, that's basically what we do. Like in a local credit market, developing country setting, that's what you have. You have generally microfinance institution lending to individuals or group of individuals. They generally tend to rely on social collateral, knowledge, group, and this kind of stuff. Okay, that's basically the microfinance literature. Clearly, in the same setting, there are also banks and financial institutions. And if you want to borrow from banks, what you need is a standard collateral, okay? So you have to pledge something, an asset. So it could be a movable collateral, a fixed assets. So you need something to pledge, okay? The point is that there are no property rights, and it's very difficult for you as an individual to basically have access to banks and financial institutions, because without property rights, it's difficult for you to post a collateral. So the only way you can have is having access to microfinance institution. And clearly, we know that, for the finance system to grow, what we really need is access to banks, because microfinance clearly cannot deliver these big changes that we need. So we really want people to have access to banks. So for that, you need property rights. But let's assume you have property rights. Our point is that this is not enough. Because again, for you, even if there are property rights, to have access to banks, what is important is that banks need to observe that you have access to fixed assets or whatever. So there is sort of an issue of like informational frictions, because you have information about your assets, but it's very difficult for the bank to gain the same information and to monitor. And so the point is that without technologies, in that case, like the arrival of some technology can actually mitigate this informational friction between you and your private information on your assets and what the bank can observe. And that comes through, where is that? Okay, through the internet technology. So the idea that we have in the paper, there is the arrival of mobile internet, and the mobile internet make the information that I have on my own asset observable also to the lender, in this case the banks. In what we see that through, and that's what we show in the paper, through the land reform, through the arrival of collateral registry, it becomes easier for the bank to actually observe the fact that I own a collateral. I can pledge my collateral, I can then borrow from banks, and not only from microfinance institutions. That's what we try to test in the paper. Similarly, this is something we do in a developing country context. You can think of the same issues also in advanced economies. You just have to switch the situation. In general, in developing countries, in advanced economies, you have standard collateral that I pledge if I want to borrow from a bank, but we also have fintech companies. Fintech companies, you tend to have like digital collateral, like big data, like our digital footprint and such. In this case, for me, to sort of borrow from fintech companies, I also again need the internet to pledge sort of what is a non-physical collateral. So the same kind of mechanism could work in advanced economy setting. But let's go back to what we do. And so our key question is simply, does this complementarity between technology and law can help overcome financial frictions, which are particularly prevalent in developing countries? So the theoretical framework we start with is this idea that internet facilitates the acquisition of collateral, make it pledgeable to banks, and therefore create a choice for an individual between borrowing from microfinance and banks. So our setting, we zoom in on Rwanda in between 2008 and 2015. We do that for 3 reasons. First of all, there are data on internet coverage. We have data on access to banks and microfinance, administrative data from the credit registry. We have data also on collateral, and there is like this land reform that happened during the time period. The identification is based on 2 sources of quasi-experimental variation in 3G coverage in the country. And so we take off-the-shelf instruments from other paper, lightning strikes, and incidental coverage, which exploit the specific variation of Rwandan geography. I'll come back on that in a second. As I said, also there is a land reform that introduced a digitally empowered collateral in the country. So you have these 3 elements together that allow us to study the complementarity between law and technology. So in a nutshell, our findings, we can show that with the arrival of mobile internet, that leads to a change in financial decision from individuals, that leads to an increase in probability of obtaining a bank loan, and the decline in the probability of obtaining a microfinance loan. So what we find is there is transition, or if you want, a switch from access to microfinance to banking. So people move away from MFIs and go into more access to banking. So we can show the switching, and we can show that comes with a lot of changes also in loan terms, loan amount increase, lending rate goes down. So there is a better and easier access to finance from individuals. So that's the first part of the paper, and there has nothing to do with the collateral part. In the second part of the paper, we try to delve into the mechanisms, and we look at the role of collateral. So we see that there is land reform in the country, and we show that there is a faster disbursement of land titles and higher transaction speed in the areas in which there is more internet. And we find this effect of internet particularly important, especially for collateralized loans. So we find evidence that pledging an actual collateral help people getting access to through banks. And this is particularly true in the areas in which there is a better access to mobile internet. Okay, let me skip the literature, but basically we built on 3 streams of literature, one on property right and legal system. That's basically the sort of the Schleifer kind of literature. There is a literature on land reform and credit on which we build on, and then there is literature general on the effect of internet, which is basically a literature in which, like two of my co-authors, a lot of other papers there. So the setting, as I said, is Rwanda. I think it's not the right place to explain where is Rwanda and how the characteristics of Rwanda, so I can skip that. But if I have to present in the US, I need the slide a little bit more. Introduction of 3G is important. It's ample and rapid. It started in 2010. And, Rwanda is one of the countries, just at the time, at least, the fastest sort of deployment of 3G connections. And we have this data from the credit registry on bank MFIs. So the banking sector, there are 16 commercial banks, privately owned. There is a large microfinance sector, which are about 400 MFIs, and offering very standard products. So no group lending, it's for individual loans. And then clearly there is also more standard local agent and group lending and such. So the data, the key data are from the Credit Reference Bureau. So these are loan level information, loan level data on loan amount, interest rate, and borrower location, and a few other characteristics of the borrower. So that covers the universe of loans provided by the banking system, meaning the bank and the microfinance to individuals in Rwanda. There is no threshold on loan size, so it really covers any possible loans extended by the banking system. At the end of the day, we have like a unique borrower identifier, so we can follow the borrower, we can track borrower across banks over time, across banks and MFIs. So if I borrow from MFIs and I borrow from Equity Bank, I can still see whatever you do. And we have information about more than 110,000 unique borrowers over the time span 2008-2015. We have data on the mobile coverage from GSM Association, covering all the municipalities most of the municipalities in Rwanda. And we have this data at the municipality level on land certificates, transaction, and the share of land which is mortgaged from the Rwanda Land Management and Use Authority. So this is the 3G arrival in Rwanda, the beginning of the sample and toward the end of the sample. You can see it clearly there is concentration in urban areas, but there is a pretty large sort of increase and variation across the country. So we exploit this variation in 3G coverage using, as I said, two instruments which are taken off the shelf, so there is nothing new in terms of contribution here. We exploit the time series variation, so the fact that 3G was switched on post-2010, and the cross-sectional variation. The cross-sectional variation will rely on the lightning strikes, and there is this negative correlation between sort of discharges and mobile connectivity. There is this econometric paper by Manacord and Tesei. And incidental coverage is basically taken from Björgren, which is a restart paper on Rwanda, showing that 3G exploit the electric grid and the geography of the country. Let me give the intuition. So Rwanda is a very hilly country, and that's the story. This is the electric grid. They put the antenna over there. You can have different situations. You can have a city or municipality or village over there. That's a signal, and you can see because of the geography, CTA get a signal. So, and it's kind of predetermined where the antenna is, and it's fine. You can take another situation, the same antenna, slightly different geography, and city or the village B don't get the signal, again, because of geography. Okay? And this is the spatial variation. Again, the lightning frequency clearly reflects the fact, that all the hilly part on the left is one. There is a lot of sort of storm compared to the part on the west, and incidental coverage is much more widespread. So it really reflects the fact that the shape of the hills in the country is very different across possible. So if you put the two things together, we are not exploiting east versus west. There's a lot of variation within the country. And then, as I said, we also exploit variation over time. So our instrument, the interaction between the pre and post and the cross-sectional variation. And here we look at lightning frequency in the center coverage. And on the y-axis, we plot the share of mobile coverage. And you can see that over time, it increases clearly, but it increases much more in areas which are below the median for lightning frequency and above the median for incidental coverage. So they're covered by the electric grid. So that's our sort of, in a nutshell, the idea of the instruments. We do balancing tests to show that through a lot of characteristics, all the municipalities are very well balanced. There are a few exceptions. We control for that in the regression. This is a lot of robustness. So look at the first part, bank credit. First stage regression, 3G coverage, as I said, of these two instruments, which is lightning and incidental coverage, multiplied by between the post-2010 dummies. So basically it's a cross-section and time dimension instrument. We have also municipality fixed effect and time fixed effect, and we cluster the municipality level. That's the first stage regression. You can see the two instruments are correlated. We do one at a time, we do two together, go through. All the paper is done with the two instruments. Then we do a lot of robustness on how we did the instruments, parallel trends, staggered, and all that. I'm not going to discuss that, but there's a lot of robustness on that in the paper. So when we look at lending, we basically run a two-stage least square, very simple regression when the y variable, so the second stage and at the bottom, is the probability for an individual I in a given municipality having an outstanding loan with a specific borrower, the bank or a microfinance institution, in a given year. And also we look at the switching and the people that switch from microfinance to banks. Okay? So these are the results. Look at just on the right-hand side, which is the IV regression. And basically what we see is that there is a higher increase, there is a higher probability that individuals start borrowing from a bank and the lower probability that individuals borrow from MFI. Nothing happened in terms of if you look at banks or MFI. So we are not looking at an expansion in bank credit. Nothing really happens. There is no inclusion. There is simply a switching from lower use of microfinance and more use of banks. We can simply look at the switching here. This is the probability of switching from MFI to bank or a bank to MFI. You can see, again, look at the IV column, and we can see there is an increase in the probability that people that were borrowing from MFI now start borrowing from banks, and the decline of the opposite probability. So there is a switching thing. Then we can do a bunch of other exercise of heterogeneity across local areas. We can see that this is basically driven by more urban, richer and more financially developed areas, which is kind of consistent with expectation. What is interesting, we look at variation across different individuals, including gender, for instance, and it seems that, the benefit of mobile technology are widespread across population. They don't discriminate between men and women, single and married people, young adults. That's the only thing we can observe, but it's pretty much the same across everyone. So there's no discrimination, if you want. Then we can look at lending terms. Similar regression. Let's just show a couple of results. Basically, when there is the arrival of the internet, there are higher lending volume and lower lending rates, especially if you look at the last three columns, which they basically identify the change in lending term for the switchers. So exactly for the guys who were borrowing from FI and now borrow from banks, this guy, the moment they transition to banks, they get more credit and cheaper credit, okay? Which kind of big effect because it's more than 2% interest rate sort of reduction when you move to banks. So, but let me now take the last few minutes to discuss about the mechanism, which is this idea of collateral channel. Oh, sorry. So as I said, like this idea that, MFIs do not need the collateral because they can rely on social collateral. Banks instead, they want a real collateral to lend to you. And so we use this data from we exploit the land reform, the land tenure regularization, which happened in Rwanda after 2008. And so basically there was introduction of a digital system of collateral registration, and clearly the role of the internet is particularly important for promoting the system and also for allowing people to know that this is possible, and also for banks to verify that you actually have a land certificate that can use as a collateral. So the reform was launched between 2008 and 2010. It's very big, like they recorded over 10 million land parcels in the country and they created this digital mortgage registry. So we have data, as I said, at the municipality level of the land certificates, this transaction of these land titles, and the land which is used as a mortgage. And so the mechanism to have in mind that is mobile internet arrives that facilitate the sort of awareness of and the transaction of land titles. These land titles can be used as a collateral to get a mortgage from the bank, and therefore you can have access to bank credit. In practice, this is what happened. If you look at the doing business indicator, with all the caveats, the number of days that you can use to register land transactions basically declined substantially around when the reform arrived, and it's exactly the period that we use. So Rwanda started from like a very bad to one of the key countries in being faster in registering land. So these are basically what we find. We can look at the municipality level, and what we can see is that where internet arrives, basically there is much more land transaction measured in different ways. So the number of transactions in a municipality, the fact that the probability for that municipality to be sort of the first using land transaction, all that is it's higher when there is more when mobile internet arrive first. So there is this connection between internet and actually the use of land titles. If you look at the share of mortgage land across municipalities, just in the cross section, because we have only 1 year of data, we can see again that in the areas in which there is higher 3G in 2011, there is the municipalities in which the share of mortgage land is higher. And the final piece of evidence, we go back and look at, again, the evidence at the individual, at the borrower level. So we look at the probability of having a bank loan, which is either collateralized or it's a mortgage loan. And we can see that that probability is actually higher, again, in municipalities in which the 3G coverage is higher. That's a standard IV regression that I've shown you before. So it's not only that you get higher probability of maybe access to bank credit, but you also get a higher probability of getting collateralized loans or mortgage lending. To sort of go in the final point to see how much is this relevant, we do this Sobel-Goodman test, which try to differentiate the direct effect of the collateral channel, and that's basically the results. If we decompose all the loans, what is explained of our mechanism by land titles is around 40%, and internet explained the rest, where internet could be everything, the higher demand for credit and a lot of other mechanisms. If you only look at collateralized loans, you can see that the role played by lend titles is predominant. So that's a way, again, to substantiate the fact that what we find is basically driven by this collateral channel, because when you zoom in on those loans, lend titles are particularly important. We have a lot of to-do lists to do, a lot of robustness check, but let me conclude. Our finding is that we find that more access to mobile internet is associated with access to bank credit. And this happened because, fostering the ability to digitally empower lend collateral, mobile internet helped the transition from MFIs to banks. And we have this idea that there is this tech-law complementarity, which can help overcome financial frictions. In some way, technology shapes financial choices, and clearly there is a key role for the land reform and collateral to help people having access to banks. Let me stop here. Thank you.
Well, this is a paper that was really pleasant to read. Quite a lot of useful parts, and I think, was it David McKenzie? He said that friends do not let friends use IVs, but this is one of the paper where maybe the use of IVs can actually be justified. So I'm going to straight go to the comments. Bear with me. All right. So the comments is going to be on interpretation and a bit on identification. So the one thing that I've seen reading through this paper is that the role of MFIs and whether they are even useful entities to begin with. There seems to be quite a lot of judgment call there. Sometimes they are labeled as informal microcredit programs, and to what extent, their importance in sort of serving the underserved market is considered throughout the paper is something that actually I wanted to know more about. I understand the transition from the MFI to the banking sector might be useful for all sorts of reasons, but also it can come, at the expense of some of the banking practices that may not necessarily be, preferable from the side of the borrowers. So the one thing that I wanted to see, for example, when you consider people moving from MFIs to the banks, is that whether we are also seeing a movement from group-based lending to individual liability. We observe that there are larger loans, but really, considering the terms of the loan, as well as, the level of credit burden that the banking sector would create is not really well reflected. And I have not seen much on repayment schedule. And there is a bit of contradiction on how interest rate is treated in the paper. I think in one of the tables it showed that there is a significant decline for switchers because MFIs charge higher interest rate. In some of the table, the average interest rate seems to be comparable. So it would be useful. I'm raising all those points to understand to what extent this move from the MFI sector towards formal financial institution is welfare enhancing. The other is that, this move, the transition from MFI to the banks, to what extent, this is a manifestation of revealed preference? Is it because, people want to do it? Or is it because, the space that the MFIs are now operating somehow shrunk? And, you could look at it maybe using administrative data, whether there is any evidence in MFI count or their market size shrinking because now banks taking a prominent role in offering credit in this market. And the other supply side issue that we may want to look at, what is happening in these areas where 3G is coming in? Do we see also supply side improvements? Do we see, large number of banks operating in these areas? Now all these points can be tied up, trying to understand, to what extent this is a sort of a welfare enhancing move, the transition. And again, this is a point I think, Andrea, you also raised. While there doesn't appear to be massive differences in financial inclusion, how about financial vulnerabilities, right? We've seen from previous work that necessarily access to finance doesn't solve all the problems that people face. And is there anything we can say by way of welfare indicators. We could look at, well-being or entrepreneurship or a host of indicators that may be available from, the various data set that you have put together. And the other inevitable comment is obviously, the GE effects. In this case where, the intervention is large enough to change various parameters in the economy, what is going on in areas where the effect does not necessarily meant to happen. The areas that are considered as not having proper access to 3G. So it is possible that there are spillover effects, potentially financial crowding out, where banks might be diverting loans from areas where there is greater demand now to areas where sort of nothing seems to be happening. I think a discussion around it would also be useful. And then looking at, I think, Table 5, I was wondering whether there has been some sort of lobbying for 3G coverage, which could actually be related with the level of bank operations in those areas, kind of, a confounding factor, if you will. A couple of things to think about. One is mobility. Again, this might be unlikely, but thinking about it conceptually, if there is greater demand for banking services, then there might be a mobility of people from uncovered to covered areas, sort of the result, overstating potentially the result that you observe. And another dimension is obviously urbanization, right? Urbanization and financial inclusion often go together, and that might sort of, tinker with identification strategy that you have. All right, these are the comments. So if you want to respond, you can.
No, thanks a lot. I mean, just a couple of things on sort of the role of MFIs versus banks. I mean, clearly we take a stance in the fact that we believe that having access to banks is better than getting a microfinance loans for a number of reasons. And, loan terms are way better. Like loan size is higher, interest rate is lower. I have a previous paper, same context in Rwanda, when we look at exactly the switching, and we show that like SACCOs as a stepping stone to get into bank financing, in which we clearly show that all loan terms are better when you go to banks than to MFI. So we take a stance on that there. I take the point about financial vulnerabilities. It could also be financial vulnerabilities, also like, that could be like a crowding out effect in the sense that MFIs are left with sort of the bad guys and you can have financial stability concern there. So there are problems. We're not aware of that. And on the other points, I think on the mobility side, for instance, like I think in the previous analysis, we look into that, like distance is so low and mobility is very limited. So I don't think it's a big issue, but I agree that conceptually it's important. I like this idea of looking at supply and, how banks react and such. We have something in the paper. And I also apologize because, I think you read a version of the paper which is kind of bad. So, yeah. And I'd like to get, if there are questions.
I guess one of the criticisms, very nice paper, by the way. I guess one of the criticisms of microfinance is often that the ticket size is really small. You're getting $50 or $100. I'm just wondering about the magnitude that you're seeing on the increase in loan size. Is that intuitive? Is that consistent with that story that the loan sizes are just far too small for some of the investment needs that people have? And the second question is, we have this arrival of mobile money. Where is mobile money-based lending coming into this story, if at all? I mean, I guess in some countries, and the telecoms are doing some lending. Perhaps sometimes they're doing it in partnership with a bank, so it would appear as bank lending. I just wondered where it is in the story, linked to Guillaume's point about GE.
Maybe we collect first, and then a group. It's easier.
Thank you very much. It was an interesting discussion. I have 2 points. The first one is about the microfinance. So we know that at the same time you are covering this study is the same time where the Rwandan government was expanding this Umurenge Sacco. How did you tease out this type of the two concurrent programs in the country. And then the second one is, we know that the interest rate, I think, in the country for banks and SACCOs, microfinance is different. So we'd probably think about how people would go to take loan on 18% interest rate, while Mwenje SACCO is 12 or 13. That also will probably be explained. Thanks.
One more question. I'm sorry, we're running out of time. Yes, yeah.
Thank you. Really interesting work and data. Maybe I've missed it, but I'm wondering in sort of your narrative, where is just people having internet and being able to look at what information banks are putting out and switching to banks because now finally they can get information on it. Like, it seems to me that there might be indeed the supply frictions being addressed through collateral, but also the important demand frictions that previously people just couldn't find information on what loans banks were providing.
I know you have to present on, I'm very super synthetic on your last point. Yes, when we do this Sobel test, we try to disentangle the two effects, and generally, like what we call it, the residual is exactly the mechanism we have in mind. But we still find that, especially for specific loans, the collateral channel is dominant. USACCO, yes, the previous paper I mentioned is exactly on the USACCO program, and here we just test for that explicitly, and what we find has nothing to do with the program. And mobile money, we would love to do that. It's something I would like to do. I really think it's generally bad. You know, if somebody has data and want to help, I'm happy to do that. Thank you.
Okay, this is a work with my colleague, Adiam, who's in DC. We both work for the Africa Gender Innovation Lab. In this project, we try to look at the impact of a behavioral financial training on women micro-entrepreneurs, the evidence coming from Ethiopia. I think there is relatively an agreement on, in the literature or among scholars, the importance of financial skill literacy, right? There is huge literature around management practices. And for small enterprises, we understand that, entrepreneurs often struggle to balance various aspects of their enterprise finances. And part of it is lack of knowledge. And the way the literature has taught about improving on this problem is by offering classroom-based training programs. And there is, mixed evidence on their effectiveness. And David McKenzie have done a recent review that shows that, in some contexts you have massive impacts, in some contexts you have null impacts. But there is an emerging evidence which points us towards, the importance of simplifying the content of training programs. And one way to do it is, to do a heuristic-based training program than, sticking on the traditional, mechanics of teaching standardized accounting practices or standardized business skills training program. So what we now thinking about is not only the content, but also we can, improve the way these training programs is delivered. That is, move away from the traditional classroom-based training program and try to implement it without, requiring people to be present in the training room. So we use, in this research, we look at heuristic-based financial literacy, and we use an IVR platform, interactive voice recorded messages, to deliver this training program. Now, this is innovative in terms of delivery, and importantly, it is quite cheap. Once, you program the training, package it in a studio, it can easily be delivered on demand. And pilots from India and the Philippines suggest that it might be, one way of delivering training programs in low-income countries. Again, as I said, it blends together innovation on content and innovation on delivery as well. So in Ethiopia, we look at the effectiveness of this kind of training program, which I will describe shortly. And we test whether it improves business knowledge, whether it changes financial behavior and business practices, and whether, by layering an additional intervention that sort of reminds people of what they need to do, can this make financial practices, salient in their mind. So basically, our focus is going to be on take-up and outcome, which I'll show you briefly. So our contribution to the literature is threefold. As I said, there is quite a lot of evidence on business skills training, management skills training, but this behavioral-based financial literacy program delivered through an IVR mechanism, there is really, really limited evidence. We are only aware of 3 studies in Dominican Republic and Ecuador, and India and the Philippines. There is a very small pilot, so I think there is something that we can learn a lot about, and also we can, layer intervention that can arrest behavioral biases that could constrain women from turning attention into action as well. Now, very quickly about the intervention. So this intervention was developed by Ideas 42. Ideas 42, as some of you might know, is a behavioral lab that develops, various forms of behavioral training components. And they use, often the program use, voice actors. And then if you want to deliver this kind of training, you need to orient people that the training is coming forward. And to do that in the orientation, we elicit the preferred window of training. That is a moment that people would be willing to take phone calls when it is called to them. And then there is an important option of callback. And this is important because unlike classroom training, if you don't go physically, you miss the training. And if you miss it, there is no replacement class that you will go and attend. But this callback option allows you to listen to the same training content on demand or at a time that is suitable for you. So this particular training that we are working with is composed of 4 lessons. One is on cash separation, basically, teaching entrepreneurs the importance of separating personal expenses from the business expense and customer credit. This is credit management, Often, while they themselves are credit constrained, they often provide credit to their customers, but they really don't keep track record of, how the credit, whether the credit would be returned, how much money that they have been given, and they often don't even have credit limits. And inventory management is important. They don't know when they are running out of inventories, and there is nothing by way of recording merchandise or processed good. Supplier management, there is similar issues around it as well. Now, to do this training, we partnered with a company called Vamo. This is a mobile service provider company. Here, they help us record the content of the training, which is narrated in a professional studio. And this is packaged into a message, which is delivered to the respondents on preferred time. One message typically ranges between 3 to 4 minutes. And this platform, operated by Vamo, allows a playback option, a callback option, and the system also allows to place multiple calls for the respondent to respond and listen. Importantly, it can also provide live feedback. We would know who have listened, how many of the segments that they have listened, and if there are quizzes and which quizzes they have answered, where the difficulties are, and so forth. Now, the sample comes from a World Bank project called Women Entrepreneurship Development Project. This is a registry containing around 40,000 women entrepreneurs in urban areas in Ethiopia. From that, we take a sample of 6,000 from 5 cities. The program operates in 11 cities. And we also use data from the Vamo platform. Here we have information on pickup rates, narrative completion, quiz, and so forth. So we work with 6,000 sample, and this is divided into 2 groups. You have, the treatment, randomized into treatment, half of it, half into the control. And then among the treatment, we subdivide them into 2. One, we give them this SMS reminder, post-training text summary around 10 weeks after the training is completed. So those are, considered as T2. And then within the treatment, there are those who are not followed up with additional intervention. And the control is divided into 2. There is a placebo group and there is a pure control. As you can imagine, if you call people for 21, 22 weeks, there is going to be experimental demand effect, right? To remove that, we work with the Ministry of Health and develop modules where we send this to these individuals using a very similar platform. Here, it's just a message around, for example, how TB is transmitted, how COVID is transmitted, and what precautions you need to take. The idea is that these are important, but not really, they are not going to change the way the business is operated, unlike the financial literacy, but at least would help us overcome the experimental demand impact that would be a concern otherwise. So we use a very standard ANCOVA specification, and we allow, we control for the placebo effect if it arises, and we try to see whether layering an SMS reminder is going to move the needle separately. So that is a comparison between B2 and B1. And we also control, we also select control variables using lasso method. Now we have a balance. I'm not presenting the table, but we have mostly a balance on the baseline variables, on business characteristics and demographics, and we also conduct orthogonality tests. There doesn't appear to be a lot, aside from marital status between the placebo and treatment, and then previous experience with financial training seems to be one of the differences that we see, and we control for this in our specification. Now, the one concern that we have, because of the situation in Ethiopia, attrition has been particularly bad. It's around 20%. So we use inverse weighting to adjust for the attrition differences. And if we do bounding, the results also don't change significantly. Very briefly about the sample, the average woman is around 38 years old. Compared to other countries, this is a relatively educated population. So during the development of this training, we look at the sample in India and in the Philippines that they have used previously to test this training, and our sample is much more educated than the sample there. So the training needs to be tailored to fit the level of education of this group. And 2/3 are married, and many of them have children. And previously, because of the nature of this program, many of them have experience of taking training, and very few are new businesses. These are really established businesses run by women-operated, women entrepreneurs who are often considered as growth-oriented. All right. So the one aspect that we would naturally think would be beneficial for this program is because it doesn't require people to turn up to the training room, take-up should be much higher. As you can see, we compare with similar training programs that have been conducted in a very similar space with similar sample. Take-up is significantly higher. If you consider pick-up rate on average across, this is across, all the 21 modules that we have prepared and delivered, and narrative completion is also higher. Quiz completion is low, but we intentionally discontinue making it a mandate at some point because we got a feedback that respondents are sometimes sort of unhappy to be tested on the phone. So we didn't want to jeopardize the project, so we removed that in the middle of the intervention. So that's the importance of take-up is one, and callback option seems to be usefully used, particularly when the program started. Around 40% used to use a callback. Sometimes when people miss the training, they can use a callback function. But sometimes when people want to listen again, if they don't understand it the first time, if they want to listen again, they can also use this function. Now, results. So the first thing we look at is that how does this intervention affect business knowledge and business practice scores? There isn't much going on. There is a bit of effect on the IVR only without the SMS training, but this is not massive. I'm not reporting the Q values here, but we have conducted multiple hypothesis testing, so the results that I say are quite consistent. So, for example, this 10% significance that you see here does not survive multiple hypothesis testing. So the one area that seems to be a lot of movement concerns financial practices. Here again, it is consistent with the nature of the training where we wanted to change how people, deal with their financial matter. And here we see huge changes compared to the control group, and we don't see anything going on with the placebo, suggesting that there doesn't appear to be some sort of Hawthorne effect here. And then inventory management score, there seems to be some movement there as well. But for credit management, it is positive, but imprecisely measured. So the one thing that we're seeing is, because inventory management is less intuitive, for example, compared to the other intervention, it seems to have people seem to have benefited from the training. Saving on the intensive margin moves, but on the extensive margin moves, but I'm not reporting it, but on the intensive margin, we don't see a lot of movement. As always, fitting the trend in the literature, there is no impact on business outcomes. But remember, this is only 8 months after the intervention. So what we are planning to do now is we are in the process of putting together a follow-up survey, which is going to happen in the next couple of months. There we try to see whether this is a lagged impact or, the intervention really did not in any way affect business performance at all. Very quickly, summary of the results. We see that knowledge and practice scores significantly improve. Again, this is what we expect given the nature of the training. And particularly the effects tend to be amplified for those who only participated in IVR training. So this seems to be a little mysterious. When you combine IVR with a reminder, the effects tend to be mediated when compared to when you do only the IVR training without the SMS. I think we can speculate, we cannot directly test. Maybe it is because we have really burdened people by, overwhelming them through these unnecessary messages, and they don't seem to have benefited anything from it. Or it might be also bad signaling, where the fact that we're sending messages might give people, might lead to this confusion that maybe this is something that we cannot do on our own without a follow-up. So this is something that we are trying to work through as well. And we see that some of the effects, I haven't presented the heterogeneity test. I thought I would not have enough time, but I would just say that some of the effects tend to be lower for married women compared to unmarried women. There is emerging literature on what's going, looking at what can go wrong within the household when there is spousal competition for resources and when a woman run businesses and when the husband can claim stake on those businesses. In fact, sometimes the interventions might lead to negative impacts. Again, that we can only speculate. We cannot tease out from the structure of the data that we have, but something that we can follow up in the inline survey. So there doesn't appear to be a lot going on savings, except those, extensive margin effects I just showed you. And again, the impacts seem to be coming from single women and those with higher education and those who own smaller than median businesses. On the bottom line, this is something we want to work on. We don't have a lot of movement on profitability, business size, or sales. And even in the heterogeneity analysis, we see some impacts arising from some of the subgroups. But again, a follow-up survey would tell us much more about it. Thanks a lot.
So, thanks so much. Thanks for sticking with the time. And this was a really nice paper to read. So I'm also involved in some work on financial training, and I know this kind of skepticism about, how to really improve this. And this is one way. So really improving the way of delivering the training to people. So switching from classroom to actually delivering it to the homes or to the businesses themselves. So super quickly, this is a large-scale RCT. It's very nice. So one of the critiques of the existing training literature is on sample size. So this paper is taking it seriously, working with relatively large sample. So this is great. Scalability also, so the delivery method via phones, this is great. A couple of other features, so really nicely done study, pre-registration rounds is quite well done. I especially wanted to highlight these like placebo treatments. So this is also a little bit related to the discussion that we had yesterday after the screening, right? So like people responding somehow to just merely being exposed to treatment, so they are taking it seriously in this paper here. Also, the SMS reminders looks like a nice feature. Now, a couple of issues. So you mentioned several times the paper from the Philippines and from India. So I see kind of like multiple ways on how you improved over that existing study. Still, isn't it possible potentially to somehow join forces and also partially integrate that? It would give you more power because it seems that the study in many dimensions is extremely similar, right? So this is perhaps to strengthen the power in interpreting some of the results further. Now, a couple of points. On business performance, I see that you want to do the follow-up potentially. What about treatment-specific measurement error? Can you do something about it? So perhaps they are just, those who went through the treatment are just better able to calculate their profits. So you can look at distributions, let's say, is there less noise in them? Potentially some like correlations between calculating the profits and then reported sales. You have these measures, so there is something that you can do about it. On heterogeneity, so you mentioned this as at the last slide, right? But most of it seems to be coming from these unmarried and more educated women with smaller businesses. So I go a little bit beyond kind of what you said in your conclusion, but this is what you find in the paper, right? These seem to be also people who are attending more classes. So is it the characteristics or is it the attendance? I'm just wondering kind of if you could potentially tease this somehow out, right? Further puzzling SMS non-effect, or rather kind of that the treatment effect goes down if you provide more information. Seems very counterintuitive. Could it be that the messages are just puzzling? I really I liked the treatment very much and then was very disappointed not seeing kind of positive effects of that. Debt taking, so this is whether potential people are taking more debt into, and then this being reflected in future gains, but the follow-up should tell you more. Treatment-specific attrition, I think, let me skip this for the sake of time. Yeah, there's few minor. I can send you the slides. Let's stick with that. Thanks so much.
Yeah, thanks a lot, Vojtech. I take these comments on the profit calculation. We could probably look at, as you said, the distribution and variance and to what extent it's different by treatment status. And whether the effect is coming from not just treatment assignment, but also potential intensity of treatment because of attendance variations. At some point we looked at it, but I think you're right. We need to probably check it again and see to what extent, the intensity as opposed to just assignment might matter for these effects. On borrowing, we actually don't see anything. I didn't present it, but it's just there's no effect coming on loan. Yeah, if you have any questions.
5 minutes.
Real quickly, I was curious if you have any measures of attention during the lessons, and sorry if I missed this, because I think one explanation for the SMSs is people pay less attention in the lesson because they know they're going to get a summary afterwards.
No, very simple. I think it's very interesting, clearly building on what he said, being on the borrowing side, maybe over time it would be nice to see. And when you do heterogeneity, like you mentioned a bunch of time, women characteristics, like marital status and such. But I wonder if you, on the follow-up survey, you can look at business characteristics. I expect, for instance, if you have you're just the fact that the effect of employment by construction is going to be 0. It's very difficult for you to become from 1 to 2. But if you have a larger business, then at the margin you can do some changes, and same for other variables.
Yeah. So can I quickly add that maybe two of them? I start with Andrea. So I think business size is one of the parameters that seem to be important because you could look at it from two ways. If those who lead larger businesses are more capable, then they may not actually benefit from this training because they know everything that needs to be known in this space. So that would be one. On the contrary, the small ones, if it is a little complicated for them, because, the average education is 11, but you have people who barely finished elementary school. For them, it might also be difficult. So I think we're dividing it at the median business size and trying to see to what extent, it moves. So far, it seems to be working in favor of the smaller businesses than larger businesses. But I think the follow-up could give us more conclusive evidence. Attention in terms of lessons. So we're doing two things, right? The SMS is separate. So for the SMS, we really don't know whether people have checked or not. But for the training, we can. We look at the duration of the call, whether not just people pick up, whether they pick up and they complete, or whether they discontinue. That we can look at. And it does not seem to be much difference among people who actually pick up. They tend to finish it. Quizzes where we had a bit of struggle. Some people are reluctant to finish the quizzes, so we had to stop it.
Very interesting paper. So I'm just curious about the strategy, like using the voice and delivering it via phone, rather than having them in a classroom and giving them the same information, getting them to give you feedback. What do you think about that kind of approach?
Yeah. No, so this is quite interesting, right? If the level of the training can be packaged into 3 to 4 minutes message, I think the IVR can be a scalable approach to reach many people easily without requiring them to turn up in person. So the content is going to be very important for the delivery method. If it is a complicated practice where you need coaching or someone needs to show you how to do it, packaging it in a text or, with a narration might be a little challenging. But business training programs or financial literacy programs are amenable for this kind of packaging. Most of the content that we've looked at seem to be okay. And Ideas 42 is actually looking at some other aspects of training programs that can also be condensed in this fashion. But the more sophisticated it is, the less likely that you'll be able to use IVR. So I think the level of sophistication is going to be quite important. There is one.
Just one quick question about, do you have some measures of price comparability between these different modes? For example, IVR versus classroom versus very intensive, and just order of magnitude difference in cost for the programs. That would be good to know.
Yeah, no, definitely. So cost effectiveness is one important selling point for this program. So we've roughly looked at it. So the one problem that we have been having is for the classroom training programs, the way that they have been delivered is using the government structure. And what you need to include in that costing from the government costing or budgeting framework is what we have been struggling to figure out. But already we know that there is huge difference between, the IVR, because the IVR is the biggest cost is just putting together the content. Once you have the content, you pay a sunk cost for the telecom provider, it can go. The marginal cost of doing it is very, very low. But the marginal cost of classroom training, as you know, is, every time people need to show up, you need to pay for the room, the instructors, and so forth. So I cannot give you precise numbers, but we're confident that there is massive difference.
Thank you so much.